So we have this illustrious panel here. All of these guys have invested so much into our community, literally and figuratively. And thank you so much for being up here. So what I'm going to do is just have each person kind of say a couple minutes on who they are, what your expertise is, and then we'll dive into questions. So I have a list of questions for them that I'm going to ask, but we are going to be opening it up to all y'all in a couple of minutes. Like once kind of like I get through my questions here. So if you have a question for them, please write it down, remember it, because you will have an opportunity to ask them. Sound good? All right. Trisha, take it away. Who are you?
I'm Trisha. I'm Trisha Funk. I am the Marketing and Outreach Specialist with the Sacramento District of the U.S. Small Business Administration. So we are 22 counties large, San Joaquin County up to the Oregon border to the Nevada border. So we are a small but mighty team that really are kind of the boots on the ground to supporting the small businesses, especially through our real rural north in the counties, and connecting them to resources, all of our programs, all of that kind of stuff. And then I've been with SBA programs for many, many years in economic development and supporting organizations that support economic development. And my ultimate background has been, for the last 25 years now, has been in finance and financial capacity building and all that kind of stuff. So.
I'm Stacy Sanchez, and I am a lead senior loan officer with CDC Small Business Finance. I've been with the company, it's 22 years this year. Before that, I worked for small business development centers, minority business development centers. I've been at the SBA. So I've got, a little over 40 years in the SBA industry. I know you probably can't tell, but I've been here in Redding like 4 years. CDC Small Business Finance is a private nonprofit. We make SBA loans as a non-bank lender. So I'm in the $10,000 to $350,000 space. We target businesses that don't qualify for bank financing. I'm a national lender, so we make SBA loans nationwide. We're an SBA micro lender, $10,000 to $50,000, just here in California. And we have what's called a community development financial institution product that also goes up to $350,000. That's typically targeted at businesses that don't qualify for SBA for one reason or another.
And you'll learn all about that by the end of this talk.
I'm Esteban. I'm actually 6'2", but sitting next to this guy makes me look smaller. So I'm with Tri-Counties Bank. So a little background on Tri-Counties Bank. Well, actually, how many of you, raise your hand if you've been into a Tri-Counties Bank before? All right, I like it. So Tri-Counties Bank, so it was founded in Chico by a bunch of local business owners and farmers, and it was founded out of a trailer. And the purpose was they had these local business owners that just couldn't get the banking they needed by these other banks that were in town because they didn't understand their needs. They didn't understand our area, their business. So they started their own bank. And we've grown over the years. So a lot of you, I've had you raise your hands because if you've been in one of those branches, you've seen employees in the branch. You've seen people in the branch. You've seen people sitting at open desks, not requiring you to sign a list to get there. So our focus is to be in the community. And you just heard that we partnered with somebody that spoke earlier already about with her business and her program to get started a women's business going. But that's our foundation of Tri-Counties Bank. What I do there is I'm the branch manager at the Redding Cypress branch, but I'm a banker. So what I do is we just focus on getting your business going, getting your personal accounts going, small business loans, personal lending. But I always just try to say all things money because we are a community, and you'll hear a little bit about it. But if it's something that I can't do, then maybe I can connect her with somebody else in the community that you may not see that, not just a no. It's, hey, I can't do this right now, but I can do this I can send you to her, and I think she can.
Thanks. Hi, my name is Sammy Cater. I'm with Shasta Angels Group for Entrepreneurs, or SAGE. Shasta Angels is a group of people who have otherwise, almost everybody in that group has otherwise started and grown a business of their own and has gotten to a point where they're interested in investing in others who are starting businesses. So we'll talk a little bit more, I guess, in a bit about what angel investing is and how it differs from venture capital and how it differs from the other folks on stage. But I'll just start by saying, when you're funding a business, it's not which one of these people up here you want to talk to. It's how can I talk to all of the people up here? Because there's space in your business and timing in your business for every kind of funding, and it's not just going to come from one source, typically.
Totally. If you want to go ahead and give it back to Esteban, let's start with you, sir. We'll start at the traditional side, where it's like, okay, like we think we have a good grasp here, and then we'll go from there. So, what are some key factors that banks consider when deciding to approve a business loan? Or like, what's kind of that initial step for business loans?
So we go off of, we call it the 5 C's of credit. So it's character. So character, you think of in its credit report, right? Your integrity to pay back the money that you borrow, your promise and your ability to do that, and then we go off of like capacity. So your capacity, once we give you that, what we think your business is going to be able to pay back this new debt, or that you're acquiring. And then we're going to go over capital. So how much that you've put into it, how much have you invested into it, and how much does this business have in reserves to take maybe some losses if you've taken some loss or a bad year. So how much are you in a spot where you can take on this if next year is not as strong as this year? And then we're going to look over collateral. Of course, collateral always gives us some kind of promise. They're willing to do that, put this up for which we don't. Technically, the bank, and we'll get into that if another question. But it's not the collateral that we want. We want you to grow. We want you to pay your loan and build on that. And then we're going to look over what is that? The last 5 C's. Sorry. What? Conditions. Yeah. So thank you. The conditions. So the conditions of the business, and every business can have a different condition. A contractor is going to have a different conditions than a restaurant. And even two businesses, that's what the beauty of business lending, that's why I really like and involved into it, is two businesses, two restaurants can have two different conditions. It's not, no two restaurants are alike. We don't have to look at them as a like business, but there you go.
Totally. So then while you have the mic there, what would you say is one of the biggest misconceptions that startup founders have when it comes to traditional bank loans?
So that's perfect because we're talking about collateral. So we get a lot of that. So I'm gonna put my collateral up. We're gonna you have my equipment that I'm willing to put up. You have I have property. I have my house. But the bank, we don't want that. We don't want to take that from you. We want you to be able to grow. We want to build your business, and obviously, right? Banks make money off the interest. So the more you pay over time, that's better for us than having to say, hey, you're not paying on this. Now we're gonna have to kind of look at what kind of collateral we're gonna have to collect, right? I would say another misconception, we get this a lot, is bank statements. You see what I have in my bank. Why can't I just get a loan, right? A strong profit and loss and a strong tax financial statement is what we're going to be looking at. And not everything's going to show and be clear on your statements, and separating out your business and personal, making it clear to us. And I would say also, like when you get into business lending, you get a line of credit. The biggest thing is the misconception is that we want you to have a balance on there long term. The business lines of credit, we want to see those as rolling cash flow. You're using them, 30 to 60 days for those repayments. It's not something you want to use for an equipment loan that you need to pay. You're going to end up paying over 5 years.
Mm-hmm, mm-hmm. Totally. We'll start making our way down to Tricia here. So can you tell us what type of SBA loans are available for startup founders and small businesses?
So any of our loan programs technically can be, so we refer to startups oftentimes like up to 5 years, right? How many of you have been in business a couple years? And you'd still definitely very much consider yourself in that startup phase specifically. So many of our programs can be utilized by startup programs. The majority of them that are used, though, is our 7A program, which Stacey will talk more about as well, or our micro loan programs. All of those programs, just to encourage what Esteban said is absolutely, like all of those pieces of the puzzle, even if you're in that startup, even if you're looking for that micro loan kind of program, you still need to be considering all those aspects of that business financing. So our 7A loan program can be also used to purchase, so as little as 20% equity. So if you have a key employee, you're looking at really kind of starting to phase in through that 7A program. 504 is real estate, so owner occupied, so not residential rentals. But for the most part, you want to buy your manufacturing facility, you want to build a new location. Those 504 programs cover all those real estate, and basically like that 7A program can cover a myriad of other operating expenses and stuff.
And I should have led with this question first, so sorry for kind of backtracking, but what's the difference between an SBA loan and a traditional loan?
That's a good question. SBA lending, it's kind of a fallacy that the SBA actually does any direct lending, because outside of disaster services, which the most familiar that everyone in the world became familiar with who the SBA is and what we do was because of COVID. Suddenly the SBA was like the popular like little stepsister that showed up on the scene.
But then the CDC's popularity was like, wait a second,
exactly.
hold on.
Exactly. Yeah, that's true. That was a different CDC. So essentially what an SBA lending program is, any of the ones that I just basically described, as well as all of our exporting programs and everything, are federal guarantees. So you go to a traditional bank, you are looking for some financing to start, grow, expand your business. Maybe the scope of what you're asking for is a little outside the risk portfolio that the bank or lending institution is able to take. So the federal government will come in and will back 80% of that loan, 75% of that loan. Just kind of depends on what your uses are and which loan program you're going with. But I mean, that's a huge incentive for for a business and a lender to be able to balance that risk from that perspective. There's also, I know you'll probably have some questions about, specifics about what, loan terms and all of that kind of stuff, but that's really why the SBA exists, is to ensure equitable capital, and for those businesses that maybe don't fit in the perfect portfolio box, that still has access to the same opportunities to really grow and expand businesses, and that's why the SBA loan guarantee really is a thing to support that.
Totally. And then Stacy, just piggybacking off of what Tricia said there, how does anything that you want to add, say from the CDC's perspective, of how you guys are different than a traditional loan?
Yeah, sure. So Tricia mentioned, the question was what SBA products can be used for startups. Well, all SBA products can be used for startups. It has to do with the lender's credit policies or their appetite for the type of loan that you're requesting. So we're a community development corporation, not the Center for Disease Control. And we're a mission-based lender. There's a lot of us. There's 260 CDCs across the country. There's probably 10 here in California. But those of us that make SBA loans under the program Community Advantage, for example, the program was created after the big crash of 2008 when financial institutions weren't making startup loans and weren't making small loans. And so they created this program called Community Advantage, which was targeted at nonprofit lenders who were already making loans, just not SBA loans. So we look at loans just like Tri-Counties Bank does, the 5 C's of credit, but we just have a lot more flexibility with those 5 C's. Because as a mission-based lender, we exist for our mission, whereas a financial institution exists for the profit of their shareholders. So, for example, we don't take personal collateral. Even if you own a home, we don't require you to pledge it. Your business might not show it has the capacity to service the debt, but it may be in such a way, you may be at such a point that we're willing to work with you on a projections basis, meaning that you would put projections together and you would show us that if I got the infusion of capital, this is what it would look like. We don't have a minimum FICO score. We do look at your credit and you do need to be current, whereas a bank might need you to be current for the last 3 or 4 years. I could probably deal with issues that you maybe had a few years ago as long as you can tell me what's changed and that, we don't expect it to happen all the time. So we focus a lot on experience and liquidity, I guess, that we want you to have some cash, as opposed to your collateral, or being able to make sure the business can make the loan payment right now instead of maybe in the future.
And do you guys have similar kind of interest rates as a traditional bank?
Well, we're very competitive. SBA loans typically range, the range that the lender can charge depends on the dollar amount, and there is a range, so the lender's going to offer you depending on how strong your presentation is. But most startups, if your financial institution is doing a startup, it's going to be at prime plus 2 3/4. We start at prime plus 2 3/4. We go to prime plus 3.5. So it's not a big spread compared to what you might get at a financial institution if they were willing to do your loan.
Totally. So anything that founders need to prepare for if they were going to apply for a loan from the CDC?
If you're a startup or an early stage company, what we want to see is that, number one, you have outside income in your household, that you're not dependent on the new business to pay you before it has a history of being able to do so. So we want to see you've got money to put into the project. Our down payment is 5% of the project amount, compared to many lenders what might want 10 or 20. And we want you to have still 15 to 20% of the total project available to you, but we want you to keep that in your personal checking or savings account or securities and put 5% into the project, so that you have that extra cash in case you aren't hitting your numbers. Then you're going to rely on yourself to put more money in, because it's really hard, in case you haven't heard, to get a loan when you're a startup.
Yeah.
So that first year, we want you to have access to your home equity line or your capital in your bank, so that you can help yourself if you need it.
Sure, go for it. And then Sammy, it's coming to you next.
I would add to that, especially in that startup phase, the aspects of a solid business plan, and aspects where you're really describing all of those 5 C's, where you're giving that information. Your business plan is that postcard or business card, multi-page business card. But it doesn't have to be that complicated, but it explains that you know all those aspects of 5 C's of credit. Understand that you also know the market conditions, right? And how you maybe are going to pivot if legislation is coming down the pike that's going to change your industry, right? Like, I think that those speak volumes for any banker, not just, if you're going just the SBA route. For any access to capital is ensuring that you can reflect very clearly and very concisely that you understand where you're at in the market, what you're doing in the market, where you're going in the market, and what expertise you're bringing to the table, in order to gain the trust that the bankers then believe, like, that you have the ability to really turn a profit on.
And those 5 C's are, one more time:
character, capitalization, conditions. There's really only 3 C's. It's just the 3 C's.
The 3 ones that matter. Yeah.
We're going to throw some extra C's in too.
Right, just for fun. Spices up life.
I do want to say, though, that you can call, you can ask questions, you can start your application without having your business plan and your projections complete. But in most cases, if you're been in business for less than 2 years, we're not going to get into underwriting unless you have those. And so they are important, but I don't want to scare you off from calling and asking questions because you don't have a business plan. Okay?
Totally. Go ahead, send that mic down to Sammy. So, we've heard about some traditional stuff and some loans and terms we're familiar with. Let's get into the crazy side over here. So angel investing, tell us about that. How does that?
So if you look on NerdWallet, they'll tell you, right? Angel investing is high net worth individuals that invest in startup businesses. There's a regulatory definition of high net worth individual, which is more than $1 million net worth, or $200,000 a year income, I think, something like that. Mm-hmm. So it's not all Mark Cuban, at $5 billion, making a big deal out of investing $1 million in a business. You go, dude, that's like a fraction of your net worth. You're barely risking anything.
Yeah, but it makes TV look good.
Makes TV look great, right? So local angel investors like us, Shasta Angels, there are angel investing groups in almost every community. Bend, Tahoe, Sacramento, in the Bay, there's many angel investor groups. Our made up of people that are not Mark Cuban, right? But people that are willing to really punch above their weight relative to Mark Cuban in terms of investing in and supporting startup businesses. There's some specifics about what we're looking for in terms of investing in businesses. And in general, the types of businesses that fit angel investing are businesses that are going to be grown and sold. So it's something that you're doing. Maybe it's a product, maybe it's a software, something that you can grow and then sell that business for significantly, meaning 10 to 20 times more than it's worth at the time of investment for the angel investor. So that's the general framework of what we do. There's more to it than that, but maybe that's a good start.
And then can you explain how angel investing and venture capital are kind of like not the definition, but the difference between them?
Yeah, so if you've got an idea and you're going to make a product, let's say it's pop sockets, right? You know what pop socket is for the back of your phone, right? So that guy's from Santa Cruz that makes pop socket, invented pop sockets. So you have this idea, you prototype, you maybe go to some of folks like that are sitting to my right and start to get some money to be able to build a functioning business that has clear potential to make profit. And then you go to some angel investor groups, many of them, because it's aggregate investing. Each person is investing on their own, but in order for you to put enough money together to take a business forward, you're gonna need 20, 30, 40 angel investors to invest in your business. It's not one. So don't think of it as an angel that comes, and then makes your business happen. That's not how it works. You're gonna need 20, 30, 40 angel investors to each invest into your business, because we are all trying to be diverse in the businesses we invest in, right? Over the last 7 or 8 years, since I've been doing this, I've invested in 14 different businesses. 3 of them are dead. One of them's giving me a little bit of money back. Some of them are really hopeful, right? That's over 7 years. So I'm playing odds here, right? That one of these is gonna really go big, and when it goes big, it's gonna cover all the ones that croaked. So that's what we're doing as angel investors. So you as a startup founder are gonna have to get a group of angel investors. It's not quite the size group that you would get through like a crowdfunding approach, right? Where you get like 1,000 people to invest $25 into your business for the chance to get something early or get a special treat or something, or just because they like you. This is gonna be a slightly smaller group than that, but still don't think of it as 1 or 2 people. It's gonna be 30 or 40 people that you're gonna have to convince to invest into your business. And a lot of them are gonna say, hey, I'll probably do it if you get 10 more. I'll probably do it if you get 20 more people. If you get enough of us, then we'll all go in, right? We're not gonna do it just because if you don't have enough money, you don't get enough invested, it's probably not gonna be enough to push things forward. So you're gonna be, when you start a business, when you do a startup, I would say, I don't know the percentages, you guys maybe know better than I do. 25% of your time is gonna be on fundraising. 30% of your time is gonna be on fundraising. Whether that's talking to loan people who are borrowing money from, friends and family that you're just trying to convince that maybe it'd be a good idea to give me a little bit of something and see if this works, or angel investors or whatever it is. So you get to angel investors, we would invest in a company. Most of the investing that I've done is through a thing called a safe note, which is a simple agreement for future equity. And it's just a way of us saying, hey, I'm going to put money into your business, and then in the future, when it's worth $1 gajillion, I'm going to make money just like you are. And that's one of the sort of criteria for angel investing, is that you and the investors be both equally benefited by the growth of the business. Once that business starts to grow and you're starting to try to scale, so now you have a successful business that's crushing it, you're making profit, you've got tons of sales, but you can't keep up with the demand for your pop sockets, right? Pop sockets are now on every teenager's Christmas list, and you can't make enough of them.
They're on Eric's phone.
Yeah, right.
Like, yeah.
You need bigger money. You need multi-millions to open a factory. And so now you're gonna get a combination of more loan money, right? You're never just going to one source, and you're gonna now be sort of attractive to venture capitalists. Venture capitalists represent a group of investors. They tend to represent, they have more money behind them. So they have a venture capital fund that they represent. It's not their own money. So when you talk to a VC person, they're just they're using other people's money that they've been entrusted with to invest in good startups that are proven to work and proven to make money, and they just need capital infusion to really take it to the next level. And that's where venture capital comes in and takes that to the next level. So.
Dynamite. Thank you for that explanation. You can go ahead and give the mic to Esteban. Yeah, clap for that. That fun fact, the term angel investment actually came from New York. I want to say it was maybe in the 20s in regards to theater and people who would invest in plays because they needed almost like these angels to show up to essentially fund these plays to get them on the stage, and then they would be paid back as the play sells tickets, basically. So that's where it came from. So anyway, there you go. So Esteban, you had mentioned, or part of the 5 C's was credit. So how would you suggest people build their business credit if they're at the beginning of that, or maybe that credit isn't a great number right now?
Yeah, that's always with business, it's always a complicated one. Usually within your first 2 years, it's really hard with bank financing to kind of get business credit going. So what we try to do is we try to figure out if there is a way to help, but that's where we can try to set up you with one of these ladies over here or a resource in the area that we know that can maybe get you some financing, get you showing like an SBA loan or a product that you've been paying a loan on for after you've reached that 2 years. And then other options, if you equipment financing, if you can get like something that's reasonable for like a vehicle or equipment that you can do and you can that report to the business, and you can count that as business credit. So when the 2 years comes and you've shown that you've been profitable, and we're seeing that, okay, this is their business auto loan, this is their business term loan, they've been paying on this. So it's always kind of there's different factors, but there are options, and that's why we have great resources in this area to connect with.
Fantastic. Absolutely. So then, Stacy, can you just give us a quick story of maybe someone who really benefited from a CDC loan and what that looked like for them, like that process?
I've been there a long time, so I've got
lots of stories to choose from.
Lots of stories. One of my favorites is it was a startup restaurant, and it's probably been 10 years now. They came to me from the Small Business Development Center, and we declined them. And so I called the Small Business Development Center and explained why we declined them, and they went back to the center and worked on a new project, and they came back with a smaller project. They were going to be a big destination restaurant, and then the second time they came back, they were going to locate in a food hall, so they're not the destination. And so we did approve that loan, and things went great. I helped them open their second location just recently. They paid off the loan for their first location, and we funded their fourth location. And they just opened their fifth location last year. So for me, that is a perfect example of what entrepreneurship is, and that is changing generational wealth. So the woman that ran the business, Gretchen, Nana, we call her. She's, in her 70s when she started the business with her son-in-law. Now her grandkids work in the business, and she has something to pass on, and her kids have something to pass on. So for me, that's why I do what I do, why I've stuck with it, is because those examples of generational wealth are, just it's very fulfilling.
Amazing, absolutely.
Well, the first loan was $125,000. And the one we just did for their fourth location was $350,000. So, it's prime plus 2 3/4 is what they had. Prime's at 7.5, so we're in the 10 1/4 to 11% range.
And then Trisha, I have about 3 more questions for y'all, and then we'll let it loose over here, So who would you say is like a prime or ideal candidate for an SBA loan?
I would say that there isn't necessarily an ideal candidate. I would say there's a few unideal candidates. So
That might be even better.
So we are a federal agency, which means they're taxpayer dollars. So anything that is federally illegal, we cannot serve from a lending perspective. No comment about that. Like it just they have actually been less restrictive. They've actually changed some of the regulations on our 7A portfolio regarding previously incarcerated. So they're actually more lenient than they have been. Things are changing. I'm sure you guys have seen the news sometime in the last year. Things are changing readily on the federal landscape of things, but truly the goal, especially for the Small Business Administration, we are one of the only mission-driven federal agencies, and that mission is to support small businesses with opportunities and resources to start, run, grow, expand, and recover. So that won't ever change. The other thing that is, who is not a good candidate for an SBA loan is if you are sitting next to Sammy and you have absolute ability on his side of the table, not the other side of the table, and have absolute ability to walk into any bank and any lending institution and get whatever capital you're looking for. And I only bring this up because I have people that literally have a conversation with me and say, you know, like, quite frankly, I'm really disappointed because the SBA wasn't really helpful at all. And I'm like, I'm sorry, you're like a white male who's a neurosurgeon and has been for 20 years and you have plenty of revenue. The bank will give you a loan. Like, you don't need help. So from that perspective, that truly the SBA is there to serve those that are in that in-between phase. So those are the two things that are not ideal SBA clients, and the SBA has a lot of resources outside of funding. So even if you're not at the funding place, you're absolutely the perfect ideal person to come to the SBA and get support and resources with all of the other aspects to get back into Estevan's and Stacy's office and really make sure that then you're successful in accessing capital.
Absolutely. You can go ahead and send that down to Sammy. Sammy, I'll let you choose which question you want to answer. Either do you want to do your thesis on investing, because I think you have a great thesis, or some common mistakes that people might make when doing angel investment?
Before I do that, though, two other sources of funding when you're starting up. I for the last 20 years, I've owned an engineering firm. I started with a zero interest credit card. That's where I got the first year's worth of money. Mm-hmm. So there's, and then the other thing that hasn't been mentioned up here, I know probably at least a third of you were here when the person from Fall River, what's her name? Amanda was speaking. And if you remember how they got their initial funding, it was through involving a partner. Mm-hmm. So that's also something to think about. And also partners not only can bring funding, but also can bring access to funding. So partners can help your overall sort of one of the 5 C's. I don't remember what they all are. Look better, right, when you're going to talk to these folks. Right now it's me and this partner, and this partner has maybe a little more stability than I do, maybe a little more experience, or maybe a little more business experience, whatever it is. So think about those two things. One is if you're just starting, you're just trying to, bootstrap from the beginning. There's ways to get a little bit of money, and you're betting on yourself. Mm-hmm. It's the old, like, what's plan B? Well, plan B is make plan A work.
Yep.
Right? Like, that's got to be your attitude from the beginning. And starting a business is a little scary, but that's the fun of it, right? So, okay, so you want me to, now I got to put my glasses on.
Sorry. Yep. Well, you can take the common mistakes that people make if you want. Your call.
I'd rather go on the positive stuff.
Yeah.
Okay, so I don't have a handy mnemonic to remember mine. Here are my major angel investing criteria that I look at. So the first one is do I believe in the founder and their team? So that's about the people. The second one is do I believe in the product or service and the market need? So over the last 7 or 8 years, I've heard about 150 to 200 pitches. So each one of these pitches, right, it's easy to get pretty fired up about because everybody's super enthusiastic and it's all super cool. And people spend a lot of time, but I got to break it down for myself. Okay, do I believe in this person? Do I believe in the product? Do I think they can make money is number 3. Like this could be a super cool product, but the overall potential to make money is quite low. And then do I think that I, as an investor, will make money when they make money? And that sounds kind of like obvious. Like, well, of course you will. You're investing in the company. There's a lot of ways that those two things can misalign. And so I need to be convinced that when, everything goes super awesome, and you're like in that cash booth where the cash is like flowing up next to you, that you're like, let me into the same cash booth as one of your early investors. Okay, so those are my four things. I should get the same first letter somehow in those. But anyway,
Ask ChatGPT.
founder,
It'll
believe in the
figure
product,
it out.
believe in the company, and realigned. As an investor and as a founder, are you and I going to be aligned going forward?
Definitely. So we've covered some kind of high topic things. So now the floor is yours. So we have, I don't know, maybe 20 minutes or so for questions. So once we get one question going, if you have a question, make eye contact with me, and then I'll know to get that going to you, okay? And then just try to make these relatively quick on all accounts, but you do you.
Do you, as an angel investor, charge a certain percentage on the loan or a certain percentage on ownership on the company, or both?
So it's not a loan from an angel investor. It's going to be an investment in your company. And so for that investment, and you can look this up online, it's a standard agreement. It's called a safe note, a standard agreement for future equity. So I say, I'm going to invest X amount of money in your company, and we're going to agree that right now, today, your company is worth $100,000 because you have an idea, you've patented it, and you've made a prototype. A lot of people think that's worth a lot more than $100,000, by the way. They might think that's worth $500,000, all right? So we agree, it's worth $500,000 today. So then in 5 or 10 years, when you sell that company for $50 million, right, and we've agreed today it's worth $500,000, then whatever I invested, I'll get 100 times that back. Does that make sense? Now, in 5 years, if you've gone under, I go under with you. There's no payback of an angel investment. The payback of an angel investment is when the company sells. Like I said, it's got to be a company that is designed to grow and be sold. That's really what angel investing is about. Because while like a restaurant would be super cool to be involved with, because I love restaurants. What is it? I don't know if everyone's seen the show Archer. I have fine dining experience. The restaurant would be super cool, but that's something where you're really, from my perspective, looking for bank loans and partners, not an angel investor, right? Because you're not growing a restaurant to sell it. Now, if you say, I've got this really cool franchising idea, and I'm going to develop it, and then I'm going to sell it to a company that does franchising, you might be able to explain to me how that world works. I don't know how it works, and say this. I'm going to increase the value of this. There's certain food that I make that is really good. I think everyone's going to like it, and we're going to have this franchise company that sells, this specific food. So yeah, how silent are angel investors? It's kind of up to each individual deal. So sometimes a founder might really bring on an angel investor, not just for the investment, but also for the knowledge of that angel investor in their specific line of work or their business, and also maybe that angel investor's connections in that business, right? So maybe there's that. Or maybe it's something where, I've definitely invested in things where I have zero expertise, although I really try not to do that anymore. Would have zero, and angel investors don't have any real say, okay? We don't have any a seat on the board, although there can be deals where stuff like that's more of a VC thing where they start demanding seats on the board and demanding control. Angel investors tend to be a little more hands-off unless we're sort of beneficial and invited, and that can happen.
My question is for Esteban, Tri-Counties. Current state of the economy, the fact that interest rates have been largely unchanged and now there's a lot of stuff in flux. Have you noticed the bank grown skittish to new ideas for ventures? And if so, have they made any have they bolstered their requirements to meet the economy?
No, I would say we when that happened, that was like 2020. We obviously got really restrictive, but as opposite now. We actually have gotten, we launched some new programs, some special purpose loans and stuff for a lot of different like minority groups, veteran-owned groups, women-owned businesses. Also, our business underwriting, which was really, I would say, intensive for years. Over the last year, we've launched some programs where we've able, like, if the line of credit is under a certain amount or the loan's under a certain amount, the approval process has been a lot smoother, quicker. Now, if the business scoring, we call it business scoring opposed to business credit, where it's a combined of the business, the personal credit, different options. Where if it's high enough, where we can get you an instant line of credit for $50,000 with, on basically what you're telling me you make. There's some parameters in there, but we call it stated income. And then if it's a little higher, it's like limited income. And then with some of the special business loans, we have some programs where some people qualify where their loan fees are actually waived. So it's actually come to the opposite, where we're coming up more creative to give more lending out there to get our small business growing. So.
Okay, cool. So this is kind of a multi-part question, one of which is for Sammy, and then the other two I don't know where they're going. It's two. First question I have is for you. Do you find more businesses being products or services that you invest in? And then the second part is for us, we're looking to start in our slow season to build up to it for a flight instruction. If you don't remember, I don't know what a receiver is. How would you recommend funding for us starting in that slow season? It would be hard to pay back a loan if we got a more of a traditional loan.
Okay, I'm just going to say real quick so you get multiple opinions here, because I would say that in angel investing, it tends to lean towards products. There have been some services, but not necessarily things like professional services like you're talking about, and that's what I do for a living is professional service, civil engineer, flight instructor. We're kind of the same. I don't know. But so I think that leans more towards my friends to the right.
So the question was, like, how do we take in factors if the season is slow at the time you're applying? It's actually very, very common. We will look at kind of over the business overall and how they do. And so like contracting, right? A lot of times in contracting and outside contract work gets really slow during the winter season. So we're aware of that. We know that November to December their statements may be lower, but overall the year they're very they produce a lot more.
I would look at it similarly. I mean, you'd put projections together. It's not based on the season. It's based on the annual or the year's period of time. And so the loan request would be enough working capital to cover those slow times while you ramp up. The hard part with your industry is purchasing airplanes. So like I can't finance an airplane because it's 180 days to perfect the lien on the plane that we're buying. And what that means is when you buy something, we put a lien on it. We place a lien through UCC filing through the Secretary of State. With airplanes, it's not the Secretary of State, though. It's, the FAA or whoever it is. But yeah, I had a great deal. It's a flight instruction school, and it was looking good, and we approved it, and then we couldn't fund it because we come to find that it takes 180 days to perfect a lien. And that's too many months where the loan is unprotected. So you would need a specialty lender that would help you to purchase those airplanes. I could talk to you about the working capital, though.
My turn. This question is actually probably going to be for everybody. Sammy, for angel funding, is it in your wheelhouse and in general angel investors' wheelhouses to also fund business acquisitions as opposed to just startups? And then this will probably be part of the question. It'll go to someone else. If that is a yes, can that be used as part of the equity injection for the down payment on like an SBA loan?
Well, basically, you'd be bringing in an investor. So, I mean, yeah, you can there are investors in SBA loans all the time. I mean, they're minority owners. They own less than 20%, so they're just an investor. We don't look at them personally. That happens a lot. SBA is a great resource for business acquisitions. So we do business acquisitions. Again, my max is $350, Most financial institutions don't want to do an SBA business acquisition unless it's 500,000. So a lot of them are 500 and above. So I get a lot of referrals from banks for less than 500. We do 5% down on the purchase. We finance the working capital at 100%. We want to see experience in the industry. Usually we want to see outside income, but there are opportunities for income replacement if the seller is paying themselves a wage, not taking a distribution. So yeah. You form a new entity to buy the business, which is why a lot of banks don't like to do it, because you're a startup. Even though you may be buying a long-term, well-established business, your business is a startup that's acquiring the existing business. So it's more risky.
Hey guys, this question is kind of for the whole panel, I guess. As investors or lenders, I'm curious, I'm early stage, so if you're sitting down with somebody for the first time, you're reviewing their business case, maybe their financial statement, what are some of the main holes or gaps that you tend to see, things that we might not be thinking about that we ought to be thinking about earlier on in the game?
I hate to keep harping on outside income, but I see a lot of early stage companies. They're making a little bit of revenue. We've got losses for a couple years going on, and for us to get past that, okay, what's going to take to get you, going? Is one, we don't want the business to have to be paying you because it can't afford to. So having that outside income, either yourself or a partner or spouse, or having savings that you can live on, that the business then is receiving all the funds. And then we want to understand what's changed. Why would this investment take you to that next level? I mean, what's happened in your projections, or why is this money going to help you get there, kind of thing. If we can understand that, then yeah, I mean, I can get past the fact that you've had losses for multiple years or whatever.
I would add that one of the biggest kind of mistakes, maybe, if that's kind of what you were alluding to, that people make, is waiting to try to access capital too late. And so maybe you're getting started in the business, and so you're really trying to bootstrap, but that also means utilizing personal credit cards and stuff like that. And then you get to a position where you run out of capacity from a personal perspective, and then try to go and access business financing. So that planning, you'll hear us talk about really be preemptive. Please don't go sign a lease on a commercial building when you're in the ideation phase of your business development. Let's make sure that you're having those conversations, you're doing that planning, you're doing that understanding of what the true costs are going to be. Rather than, I think this is about the amount of money that I need. I think I need 1.5 million. Well, what is that for? Well, I think this is going to cost this, and this is going to cost this. Invest the time and energy in that planning phase of really, truly understanding what your numbers are, and then make sure that you are not waiting too late to try to access capital.
Just add one thing. So, sorry, Sammy. He made a comment about use your 0% in your credit card, and I'm thinking, oh, don't roll your eyes. But if you use those 0% credit cards and you're still not where the business is profitable enough, it's really difficult to get a refinance. I get lots of calls where people have, spent all their credit card money, they've, exhausted all their funds, and now if I could just refinance for them, then they would have a lot less and they think they could be okay. No, we don't refinance unless your business is profitable enough to show that you can pay that loan. So the most difficult SBA loan you could ask for is a debt refinance. Just saying.
Okay, so I started my business before Katie moved to town and started this whole community. If I'd have been in the crowd now, I would know that. Nobody's saying I did it right. I think one thing you've got to do when you're talking to anybody about money is try to see the investment or the loan from their perspective. And the thing that I think the biggest mistake that I see is it's very rare that the first idea you have is what you will succeed with. And if people just really get locked on to that first idea and won't let go of it, then a lot of times that can be to their detriment. Because you've got to let the market help you develop and change, and the word is used a lot, but pivot. But you've got to be able to adapt to what the market is telling you about your product and swallow some pride a lot of times about how cool your initial idea was. And you might be hearing from people with real experience about something that you maybe want to consider. And I've seen a lot of people sort of blow that off and to their own detriment, right? So you've got to sort of be really willing to set your ego aside when you're running a business and just really respond to the marketplace. And the more you can kind of show up every day and think about yourself as serving, this is my little business advice to everybody. Every day, when I've run a business and I've had some success, every day I wake up and figure out how I can serve the people that work with me. And that's how I think of it, as people that work with me, not people that work for me. I've never used the word for in a company that grew to 100 people. It's people that work with me and how can I serve them? And that's leading, right? So you got to think about how can I serve my customers? How can I serve the people that are providing whatever you're doing? How can I serve those other people and make their lives better, make their jobs easier, so that then it makes my business better? And that takes a lot of putting away your ego. You never get to a point where people are serving you. Just not how it works. Sorry, that's totally my fault. I'll stay late.
I would just do the Sammy show,
No, what are you talking about? Dude, they have all the money.
Okay, actually, my question was on what you guys were touching on, because I got in a situation where I need to refinance credit cards because I had floods and I had to keep going and whatever. So, and before I understood the difference between personal loan and business loan, because I'm thinking never carry debt, and then I'm like, oh my God, I should have taken out a giant loan and then I would have been fine. But is there a way, if you find yourself in a situation where it's like, okay, my interest rates on my credit card are insane, but if I could get them lower, then things would keep moving. The business is growing, it's exponentially building, but I need to get from underneath. I need to refinance that credit card so I can actually keep going.
One thing I want to point out is that, I'm a nonprofit lender, an alternative lender as we're called, and there are lots of us throughout California, and there are lots of different SBA lenders. So you might have to call a bunch of them to figure it out. We should talk though, and so I could give you a more personalized, here's where I think we can go, or here's what needs to happen, etc. But you might have to hear no a couple of times because every lender has a different appetite for risk. Right now we have a concentration in our loan portfolio. I can't do restaurants, bars, and caterers, but I am well connected with all the other alternative lenders, and when people call me for that, I have a referral source for them because we all, we're all in the same business and we sort of refer back and forth to each other. So, sometimes you just have to call a few and find out. And maybe one lender will do this much and then the other lender can come in and do the other part of it. So sometimes it just takes a little strategy.
Fantastic. Well, did anybody learn something? Yeah? That's thanks to all of these 4 people right here. So guys, thank you so much for your time and your expertise, truly. I have something for all of you, so don't leave too quick, okay?